I want to thank everybody who is attending today's session. I think it's fair to say 2020 has been a difficult, strange, surprising, and frankly, in some ways, very remarkable year. Today, I'm going to speak about consumer trends in a pandemic economy. And as Matt said, at First National, I run the partner segment, which includes the credit card business. And we manage over 3 million credit card accounts in all 50 states. And they include co-branded accounts. They include agent bank accounts. We issue credit cards for other banks. We issue commercial and small business accounts. And we also have our own national business as well. In total, it's about $6 billion in assets and about $20 billion in spend. So we do have considerable insight into what's been happening and how consumers are adapting and changing their payment habits as they manage through this crisis. Now, for all of us, the COVID pandemic has been quite impactful, not least, frankly, the very real ramifications on each of us individually and our families. But from an economic and behavioral standpoint, there have been a number of contrasts that have been surprising, and some of which I wouldn't have predicted, certainly not going into this. So today, I'm going to divide my presentation into 3 sections: consumer impact, economic impact, and consumer credit impact. So let's begin. So let's begin with the consumer impact. Well, one of the more interesting things that has happened is that we've had a massive acceleration of digital adoption. Tongue in cheek, I would say it's 10 years of digital acceleration in 90 days, and we'll show that in a minute. But it's not all been good. For those of you that are parents with young children, you probably know that virtual students are struggling to keep up. And in some cases, it's actually quite bad. It's not keeping up at all. But let's start talking about some of the positives. These changes have occurred over the last 9 months, obviously, with the onset of the pandemic in the US in early March. Chief among them, as I said, is this astounding acceleration of digital engagement by consumers. And that's particularly true in the areas of commerce. And in many respects, this change has been positive, as digital experience facilitate easy, seamless transactions that allow for the fulfillment of goods and services anytime, any place. And by the way, this trend is going to continue and will have lasting ramifications after the pandemic for sure. But it's become increasingly clear that widespread adoption of digital always isn't optimal. And that's particularly true of learning, as we'll see. First, on this page, look at the chart on the left. That you can see that what this is US commerce penetration as a percentage. Look what happened from 2019 to April of 2020. It more than doubled from 16 to 33%. This is huge, and it wouldn't have been expected last year, for sure. It has impacts for all businesses, including ours and yours. But as I said, this engagement isn't all positive. And an example is the fact that many folks in our country, we estimate between 6 and 7 million, don't have home internet access. And this affects a lot of school kids. Interestingly, my brother and his wife are both New York City school teachers. And they tell me that beyond limited internet access, there are also issues with a family's shared PC equipment, coupled with often tight living spaces, especially if you're in an urban area. They're often competing for privacy, especially in apartments, and schools were not set up for remote learning. And I think that's generally true throughout the country. In my brother's case, he sees a maximum of students twice a week. They stagger it like they're doing it in many areas of the country. And For what it's worth, and I know this is anecdotal, but I think it's still instructive. He doesn't like it and feels kids aren't as focused. And I think he's right. It's not been good, and a large cohort of students are definitely at a disadvantage. In a sense, this has been a lost year. So moving on, a lot of families, because of that, have reduced working hours for at-home learning, and money remains a stress in their life. Families with children have had to adapt to learning at home. In fact, 34% of them had reduced their work or hours to tend to at-home learning needs. Not surprisingly at all, that's leading to some financial stress. In fact, 64 adults recently surveyed say that money is a significant source of stress in their lives, and 52% say they have experienced negative financial impact, specifically due to the pandemic. Now, another dynamic, as we all know, is the work at home has been somewhat of an incredible bonanza in the fact that so many of us can do it, but not everybody. And we'll talk about that in a second. The front line certainly can, but also others. I will tell you that I was surprised at the very beginning when I was able to take my entire front-end workforce and effectively have them work at home quite successfully. Over the last few years, much of my management team would come to me and ask if we could prioritize the work at home capability. And when I looked at the technology requirements for it, I always thought it was just too much resources and we had other things we needed to do. And so it always was on the back burner. And this was true for at least 10 years here at FNBO. I was shocked when really within a matter of a week, we were able to pivot and pretty much move our entire workforce pretty much at home. And it just shows you what we're capable of when there's a sense of urgency and our back is against the wall. But it turns out when you look across the United States, it's estimated that 37% of all jobs can be done permanently at home. And actually, remote friendly jobs account for 46% of all wages in the country. But obviously not everybody can do that. Frontline workers, by and large, need to be in a physical location. And that includes broad categories, obviously healthcare workers, but also food and agriculture, emergency services, transportation, distribution, and the like. So this is going to have ramifications for us, I think, as a society, and I'll get into that a little later. But I know every business is beginning to rethink its office space and its configuration, and people are more mobile today than they were, and we'll talk about that in a little while as well. But next, rent and payment defaults are on the rise, while the housing market and new home sales continue to rise. They're soaring, actually. Now, as Matt said, I've been in the consumer lending business for a long time, and it's probably no surprise that payment defaults would rise during a time of economic stress. According to the Mortgage Association, over 6 million households missed their rent or mortgage payment in September, pardon me. But at the same time, and this is surprising, the housing market and home prices are on the rise in a very big way. And you can see on the chart on the right, pending sales are up 32% from the same time last year. That's huge, and I'm sure we all observe this in our community and around the country. Home prices and demand are very, very strong. Next, we are venturing outside more, which I think is good, but infection rates, as we know, are spiking. It's clear that we're adapting to the virus. I see that in my daily life. And I also see that in the macro spending numbers here at First National, as well as the industry statistics that I regularly review and on an ongoing basis. And I'll share some of those shortly. But infection rates are on the rise. And unlike in the beginning of the year when widespread lockdowns took place across the country, we're collectively taking a more measured approach. Oops, pardon me. Mask etiquette and social distancing are deployed in most places. It's interesting that as of October, 39% of US adults now feel comfortable going out to eat. And I think that's good. All right, we're going to move now to review some of the economic impacts of COVID. Now, unemployment is up, GDP is down, and surprisingly, credit scores are up. Now, as I said, I've been in consumer lending for a long time, and I can tell you when unemployment goes up, and this should be no surprise, and GDP contracts, that's usually reflected in consumer credit scores, in average consumer credit scores at large. But that's not what's happened. Jobless rates, as you can see, have exceeded 15% earlier in the year. While it's now less than 7%, that's still much higher than what it was when we started the year. And look at gross domestic product, the left lower chart. That's the total value output of goods and services in our economy. A dramatic dive. Thankfully, we've recently seen a V-shaped spike, but it's still down from where it was. Yet, on the chart on the right, you see that the credit scores have risen, and actually recently risen dramatically. This does suggest that consumers at large haven't felt the impact of the economic duress in recent months. Now, there's a lot of reasons that could be true. Most companies have offered forbearance programs, and we're no exception to that. There has been a lot of government stimulus. There's also a lot of savings, and people are not spending as much as they used to. And we'll talk about that in a little bit. But so far, all of this has conspired. The consumer is actually in much better shape than I would have thought at this point, and that's good. Amazon and Walmart are thriving, yet many businesses are hurting. One dynamic that we've seen even before the pandemic was the closure of brick and mortar retail stores across the country. We spoke about the acceleration of e-commerce earlier and how in many respects that's been good for the consumer. But of course, it hasn't been good for many businesses, especially those that haven't adapted to the digital economy fast enough. Case in point is Walmart. Now, Walmart's revenue was 7% for the first 6 months of 2020, up 7%. Its commerce activity actually surged 74% in the first quarter alone. Clearly, Walmart has benefited from this pandemic. But look at the chart on the right. A lot of retailers have not. And what this is showing is the cumulative number of retail bankruptcies that have gone bankrupt. And usually these are brick and mortar and physical. We expect 25,000 retail businesses to close by the end of 2020. And take a look at some of these names. Papyrus, Pier 1, Modell's, JCPenney, GNC. These were well-established names. This trend will continue, and it's part of the acceleration that what we discussed. If you can't adapt, you're going to go under. Now, travel spend has vanished, while discount, retail, grocery, and wholesale spend has increased. I believe the biggest hit the economy took was in the travel and entertainment space. It was shut down for a number of months completely, and frankly remains vastly reduced from what it was. This has been one of the body blows that our economy has taken. Meanwhile, wholesale clubs, certain retailers, certain sports retailers are booming. But overall, it's not been enough to overcome the hit for the economy, particularly in travel and entertainment. And I would draw your attention to this chart. Look at the decline in airlines, the year over year. This is a year over year comparison of lodging, of vehicles rental, of entertainment, of restaurants. You know, it really is amazing. In my career, I've never really seen anything like this. And the economy tends to be indexed on the left side, more so than the right side. And certainly we felt this here at the bank, and we'll go through that in a little bit. Now, tech companies remain unaffected for the most part, but hotels, restaurants, small business are actually fighting for survival. Now, we spoke about Walmart earlier, but look at the revenue spikes of Amazon, 35%, Facebook, 17%, Microsoft, 13%. And while that's occurred, huge swath of customers who recently shopped at a small business closed permanently due to the pandemic. And it was broad-based. It didn't matter if you were in an urban area or if you were in a suburban area or if you were in a rural area. Everybody is observing this. Everybody is feeling this. Now, this is interesting, and I'll maybe add a little color to this. Bay Area tech workers are relocating across the country, and they're widening wage gaps and raising real estate prices across the country. And in fairness, this dynamic isn't just the Bay Area. Certainly, New York City, Chicago, other large urban areas are experiencing the same dynamic. It's just the fact that many high-end wage earners are moving out to larger cities. As we touched on earlier, remote working means that you're not bound by a traditional office. You can work anywhere. So many urbanite workers are moving to other states, often with lower taxes and a better quality of life. In my home state, where I come from, huge numbers of people are moving to Florida. But this dynamic is all over the place, and it's having an impact on housing demand and wage gaps. The wage gap has increased between 20 and 30,000 between tech industry workers and local workers. And as I said, real estate is booming, and usually non-traditional areas. Look at Bozeman, Montana. In 1 year, the median price, home price, has increased over $80,000. I mean, that's just unbelievable. And I believe that trend will continue for some time. Now, small business revival is in danger, but here's an interesting caveat. Millions are starting new business right now. We talked earlier about the stress of small businesses, and in general, that's backed up by what people believe. Most people believe businesses are doing poorly in their community, regardless of area, whether it's urban, suburban, or rural. But interestingly, Americans are starting new businesses at one of the fastest rates in a decade. Now, it could be a function of having more time. It could be an outcome of the changing economy, moving to e-commerce, digitization. And it is a fact that innovation tends to occur during a recession. We've seen that throughout history, honestly. That tends to be a rule. So it will be interesting after this period of time is over, what emerges. And I suspect it'll be very cool and very interesting. All right, let's move to our next topic, which is the COVID impact on consumer lending and credit cards. Now, when the pandemic happened, banks tightened up access to new credit. Every financial institution pulled back or shut down proactive marketing. That was true across the board, and you all probably noticed that. In fact, the mailbox was less full for a number of months. Volumes reduced more than 80% from April through July. And the reasons were that we didn't know what was coming our way, what financial tidal wave was coming at us. And also during this time, there was an unprecedented number of consumers that opted into forbearance programs that most financial institutions, including our own, allowed and actually promoted proactively. And those forbearance programs would allow you to skip 1 or 2 payments. So you saw a huge buildup in frozen debt per se, and that created a lot of uncertainty. So it's probably no surprise that you saw a huge decline, but it's coming back. They are beginning to rebound. Mail volumes are around the country are expected to increase actually even more in the next few weeks and months. So it is coming back. Now, total consumer debt is up. However, revolving debt is down. And this is an interesting chart. This chart on the left shows you the total debt. It's clearly leveled out, but nonetheless has risen 130 billion since February. Much of that is mortgage. But look at the chart on the right, and that's your total revolving balances, which is mostly credit card. That's seen a significant drop. It's down 115 billion from February of 2020. And actually looks more like 2017 if you were to compare where we were back then. So the consumer is actually self-regulating in a way that I think is very positive and beneficial. All right, next, overall credit card spend is down, and yet debit card spend is up. Now, in 2020 so far, 44 million Americans have used a contactless device, whether it be a credit card or a mobile device. These forms of payment are clearly on the rise, and they include things like Apple Pay, Samsung Pay, Google Pay. In fact, FNB is in the process of converting all of its cards to contactless. We started it a few months ago. It will be complete by next year. But clearly, consumers are concerned about paper money. And I wanted to throw this chart in for you guys to see. Now, this is the kind of a chart that I've looked at for years, actually decades. And when you're in the payments business, you always compare how a credit card, a debit card, a check is doing against cash. The green line is the amount of payments that are undertaken in cash. For the first time ever that I've ever seen, cash now is below credit and debit. Never seen that before. And I suspect this is a trend, while it was in play for years, it's really going to accelerate now. And that's an interesting observation. And of course, digital and touchless payments are rising, as I mentioned. Consumers are just using this way of transacting more. They're more comfortable with it. I don't know how many of you have a contactless card. Once you use it, you really don't want to go back to the old way. I think it's very convenient. It's very easy. And the adoption will be, I think, very strong. It's interesting that the United States has been a laggard when it comes to contactless payments, particularly on credit card. In countries like Australia and in Europe, they account for the majority of transactions that occur at the merchant, in excess of 90%. We've been laggards partly because we've been a little slow in making the investment. It is costly to create these cards, and of course the merchant has to have the infrastructure to do it as well. But we're moving very quickly about it, and especially as consumers are just worried about handling paper money. So COVID continues to impact key growth metrics, and the results look different based on the partner and the industry. And I wanted to show this chart. This is actually First National's credit card, a picture of what happened through October. You can see on the upper left, these are the new consumer credit card accounts, and it's a year-over-year view. So not surprisingly, we booked a whole lot less credit card accounts beginning in March, and we continue to do, although it's improving. But we're still, at the end of October, we were still below 8% from last year. And the chart next to it is the purchase volume trends. They too show a marked decline since March. It's improved, but as a banker, you never want to see this. Or frankly, in any business, you don't want to see declines like this. And what's displaying on the bottom is that customers and our partners behave differently. And what you see here are a tale of two partners. One is a retail partner of ours, and the other is a travel and entertainment partner. Not surprising. It's interesting to see what a body blow it was for the travel and the entertainment partner versus the retail partner. The retail partner has actually had months where we're over last year in terms of both accounts and purchases. So, again, it's not that the pain hasn't been felt evenly. And of course, the T&E sector has been a huge hit for our economy and for institutions as well, like ours. So where does it end? Well, I'll be glad when 2020 is over with. I think, in summary, consumers are going through huge challenges, but they're still quite resilient. The economic trends, in some respects, are defying history. And honestly, they may emerge stronger than ever because I believe there's so much pent-up demand that when folks feel safe in going out and in particularly traveling and embracing restaurants, you're going to see a huge spike. And consumer lending is strong. It is facing consumer-driven change, like contactless mobile payments and less cash. And that change is likely to continue. But what's good, I think, is the consumer has self-regulated their debt in a good way for us. So lastly, I wanted to talk a little bit about FNBO and how we're evolving. FNBO is changing with the times. We're innovating rapidly, especially in the areas of marketing, credit management, and digital. A lot of this is being facilitated by machine learning. We're using these new techniques and these new capabilities to vastly improve our marketing, using alternative and real-time data to reach individuals, presenting them with product offerings at the right time that are also uniquely tailored to them is going to be critical, we believe, in the future. We're also using machine learning models to better underwrite and expand credit. It's funny, when I don't know, it predates me, who created the first score or when. I suspect it was in the 50s or the 60s, probably Fair Isaac. But you couldn't have a modern consumer lending franchise without a model that predicted good, bad odds. And we've certainly optimized those models over time, and they're better and better and better. But when I think of machine learning, it's almost a paradigm shift in terms of capability and what we're able to do using data. We can penetrate populations that we in the past would have stayed away from. We can find good individuals that had bad credit histories. And we're able to better calibrate credit lines to individuals' needs and manage them proactively. So it's as a consumer credit guy, it's a very very exciting time to be in the business. But a huge underpinning is also the digital transformation. We are spending tens of millions of dollars modernizing our digital environment so that we can become best in class to our customers. We see, as we talk through the presentation, you can see that the businesses that don't adapt and change with the times risk extinction. That's never been lost on us. Even pre-pandemic, we were investing a lot in this area, and we have excellent capabilities today. But we don't believe this trend is going away, and we will continue to modernize and upgrade our experiences. So to end, we are evolving our products, experiences, and markets. We are looking always at alternative payment solutions. I've talked about our contactless, and I think it's vital capability for spending in the future, and that we're going to be tailoring products to all markets, to all generations, to all individuals. And my dream as a mass marketer is to get away from marketing to populations and really getting down to the individual. And we are almost there. So with that, I want to thank you for listening. And Matt, I'll turn it over for any questions.
Awesome. Thank you, Jerry, for that presentation of perspectives. I think, we're all certainly feeling the effects of COVID, but as you illustrated with the data, certainly in varying degrees. So let's jump into some of the questions that have come in. A lot of questions around the election, the economy post-election. So with the election now behind us, but with the pandemic still very much in front of us, what do you expect for 2021? And what are some of the drivers that you think will impact the economy in 21?
Yeah, that's a good question. And I'll be honest, I don't think anybody really knows. I think if an economist gets it right, honestly, I think they're going to get it right by accident. And I say that somewhat tongue in cheek, but I don't think any of us fully anticipated how 2020 was going to behave, even after the pandemic was upon us. So for what it's worth, I'll give you my opinion, what I think is going to happen. I think 21 is going to be actually a very good year, in large part because there's so much pent-up demand by consumers. And there's a lot of excess cash. The savings rate, which I didn't mention, is actually quite high by historical standards. And I think people are just cooped up and want to get away. And I think that means that planes are going to be filled, hotels are going to be filled, restaurants are going to be filled, resorts are going to be filled. And that in turn spurs a lot of economic activity. So now, you didn't ask, but I think it's relevant to this, what happens after 21 and 22 and 23? I mean, there's a lot of very smart people that think that, all the stimulus and the shock that we've endured is pushing the inevitable reckoning out. And, some smart economists that I actually respect quite a bit, including Visa's economist Wayne Best, does believe that in 2022 or 2023, you're likely to see a recession. But again, he could be wrong. He has been wrong in the past. Nobody really knows. But for what it's worth, I do believe 21 is going to be a very, very strong year.
So speaking of some of those drivers and potential variables impacting the economy in 21, obviously the amount of stimulus dollars that came in 20 trillions of dollars pumped into the economy. What are your thoughts on the effectiveness of that stimulus, particularly as you looked at some of the data that showed consumers almost self-regulating by reducing revolving debt?
No, I think that the stimulus was necessary, and I include the payment protection program in that business. I think it extended necessary relief, and I do believe there are a lot of individual consumers that need relief as well. it's always, I think, a dangerous dance, if you will. I mean, we are beneficiaries in the sense that our currency is in demand all over the world. If it were not, this would be a different story, and the bill would be due, and there likely wouldn't be stimulus. But we are in a very lucky situation where we can effectively finance the stimulus, which is what we've been doing, and that's good. I obviously, for now, when interest rates are very low, and the service against this debt that we build up is very low, things can go on just fine. I think in an environment sometime in the future, when that is, I don't know, it could be 5 years, 10 years out, when interest rates, come back to anything like normal and the debt service increases, that could crowd out a lot of investment nationally in the country. So, I have a mixed feeling towards that, Matt. I think it was necessary. I actually do, and I think it did a lot of good. I have a little trepidation in the future, as the reckoning of servicing this debt comes due.
Circling back to your points on some of the hospitality-related industries that you'd expect a little bit of bounce back in 21, what sort of measures do you think will be required to restore consumer confidence in going out and participating in those activities? Is it a vaccine? Is it effective social distancing? Is it some of the contactless payment options that you discussed?
No, great question. And I should have predicated my comments on 21 with the belief that I strongly think there will be a vaccine that will be, broadly taken, and I think that's sort of the magic pill that gets the economy and the consumer back on track again and restores some of these sectors that have been so badly hit, like travel and entertainment. So yes, a vaccine that is widely available and accepted and taken, I think, is the first prerequisite to a strong economy. I do think we've sort of normalized social distancing and mask etiquette and wearing. But if for instance the vaccine doesn't come, or if it's delayed later in the year, that will have an impact on 2021. And I think you would then push out the boom till 2022. It does mean that more stimulus, more than the one we're currently talking about, might be required, and that, like I mentioned earlier, carries its own ramifications down the road. So I guess that's a long-winded way of saying I do believe the vaccine will be available. I thought the news last week was fabulous, and I'm counting on that. With that, I think you see a strong 2021.
Gotcha. Speaking of the resiliency of the consumer that we've seen so far through the pandemic, I think coming out of the Great Recession, we saw a lot of corporate customers and organizations take a concerted effort to strengthen balance sheets, perhaps implement more conservative operating models utilizing less leverage, ultimately positioning them better to sustain or endure the next downturn. Do you think consumers took a similar approach, and has that helped them kind of maintain that resiliency through 2020?
Yeah, it's a good question. Certainly the numbers would suggest that they do. I mean, we saw that earlier in the presentation with revolving credit, that they seem to self-regulate, at least on the average, and that's good. Look, there's no doubt that the stimulus checks helped as well. Couple that with the extraordinary increase we've seen in national savings rates. You do have a consumer that is in really good shape. Really, I'd like to say that, we do a great job managing that. And I do. I think, we try very hard to manage credit lines, to extend credit to customers that we know have the ability to pay back. I mean, that's why we have jobs. I mean, we're very mindful of that, and we try to do that with a great amount of predictability and control. Um, but when I look at, the consumer, I think, I'm astounded. And actually, this isn't the first time I've seen this. I've seen it in other recessions as well. The consumer does a pretty good job pulling in the reins. So I guess if I were to answer, it would probably be 50-50 or 40-60 split. I'd say consumer to institution.
Gotcha. Back to that concept of contactless card adoption, how do you see that playing out, and how do you see that maybe accelerating as a result of 2020, or has it already? And what are your expectations going forward? And does it consist primarily of the ability to tap a card, things like Apple Pay, Samsung Pay, or what other innovations might be out there in the way of payments moving forward?
Well, there's a lot of innovation going on. And certainly I do think the contactless experience is a very positive one. And I think as consumers, especially with a credit card, you could argue that sometimes the mobile phone is a little awkward. I think once you get used to that, though, that goes away. But once you use your credit card and it's so quick and instantaneous and it's safe and secure, I don't think you're going back. And I see our adoption of contactless to be equivalent, to what we're seeing around the world in Europe and Australia and even in Canada now. And I think this is going to happen between the rest of the year and mid next year. So in terms of innovation and what's happening, an innovation that has been underway that is interesting is sales, credit at the point of sale. People actually taking installment loans, not using their credit card, but taking an installment loan, what is often a very low cost item, sometimes, $100 or less. We're seeing a huge adoption by millennials. And, a stat that I saw out of Australia was just fascinating, that something like 25% of all the retail sales in Australia are undertaken through a point of sale installment loan. And you have a number of firms in this country taking advantage of that, and some of them are startups. But virtually every bank, including our own, is looking at this very seriously now and looking at ways to facilitate payment transactions with point of sale installment loans. So that Australia number is quite interesting. Much of that can occur during the e-commerce transaction as well. It's not all physical point of sale, but that's an innovation that is really accelerating and taking the industry by storm.
Great. Well, Jerry, with that, I think we'll move and wrap things up for this session of FNBO Business Insights. I want to thank you for taking the time to present to our audience, and also thanks to the audience for tuning in today. We'll be back in January for a discussion on interest rates, including all things from a crash course on interest rate terminology to a current update and outlook on the rate environment, as well as the financial sector's transition away from LIBOR. So thanks again, everyone, and we look forward to seeing you all in January of 21.
Thank you.